We'll start again. Hello, Katie Wontok with UW Extension Farm Management Outreach Specialist. I'll be joined by Rob Holcomb, educator with University of Minnesota. Today, you're joining us for tax planning for producers receiving loan servicing assistance. We do have an article that Rob wrote as well on our website, and we'll put that link here in the chat in a minute. This work stems from AgFTAP, the Agricultural Finance Tax and Asset Protection Grant. And Rob, I'm sure we'll talk more about it, but it is a portal and a resource to help farmers and ranchers and their ability to understand and navigate the farm business tax and asset protection strategies for their operations. It's part of USDA's Farm Service Agency's $10 million investment in its new taxpayer education and asset protection initiative. And so in the state of Wisconsin, Kevin Bernhardt, farm management specialist, as well as myself, will be leading outreach over the next year focused on asset protection and tax issues. More of that programming will come out in the near future. But today I am joined by Rob Holcomb from the University of Minnesota. And Rob, I'll let you kind of give a little bit of a background. And Rob is our main host and presenter in today's webinar.
All right. Well, thank you, Katie. Appreciate that. I want to welcome everyone for joining us today. This is, I guess, what I consider a very interesting topic. Again, my name is Rob Holcomb. I'm an extension educator with the University of Minnesota Extension. I'm officed out of Marshall, Minnesota, so I'm in the far southwestern part of the state, but I have statewide duties. Now, primarily what I work with in Extension is the ag business. I'm on the ag business management team, so I'll touch on farm estate transfer issues, labor management, but my main focus is going to be on taxation issues. I also am the faculty coordinator for our tax schools run through the university for tax professionals, and I've been an enrolled agent for over 20 years with the Internal Revenue, which gives me essentially it allows me to represent clients before the IRS. So without any further ado, let's go ahead and dive in on this. The whole idea behind this talk is that last summer in August we had the passage of the Inflation Reduction Act, and that had a not a debt forgiveness component. The technical term is loan service assistance payments, and we'll touch more on that a little bit later. But this is not debt forgiveness; it's actually ad hoc payments. So the people that received this were largely going to be folks that were in arrears on some type of FSA loan, either direct loans or non-direct loans. And, we'll talk a little bit about the mechanics of how those loans were paid off as we go through. Now, and I believe Katie might have put this link in the chat. This is a Z-link through our website that you can access a copy of the PowerPoint, which is primarily the handout that we'll be using here for today. So and again, this is in the chat as well. But they know that there is a handout that you can download. Now, folks, I kind of like the way our Minnesota Department of Revenue guy at tax schools always says that this information is current as of today, and that's always what we want to lead this thing off. I mean, we're not necessarily giving you tax information. This is for educational purposes, and it's a culmination of material from LGUDF is the Land Grant University Tax Education Foundation. Those of you in Wisconsin, that very likely your tax professionals, if they go to the university tax schools, that they're using the same books that we use here in Minnesota, and that's put out by LGUDF. I'm also part of the realtax.org group. That's also called the Pub 225 committee, and also we're pulling some of this stuff from the Internal Revenue Service website. I always encourage everybody to be good consumers of professional services. One of the scariest phone calls that I can receive as a as a tax professional / educator is somebody calls me up on the phone here at the extension office, and the first thing out of their mouth is, "Oh, I'm doing my own return and I'd like some help." Um, Folks, taxes are getting so complicated. I really think folks do themselves a disservice if they don't seek out some type of a tax professional to help them out with their return. I really think you do yourself a disservice if you don't do that. I've never picked up a return that was self-prepared by someone that didn't have some formal training, where there weren't a lot of, just a huge amount of mistakes on that particular return. So, be a good consumer of professional services, consult with your tax professional. Okay. Already acknowledged this. Land Grant University Tax Education Foundation is where we're getting some of this. Realtax.org. We've got the code to get to that, as well as Internal Revenue. And without any further ado, agenda. What we're going to do with the talk today is we want to talk just a tiny bit about record systems and character of income, and how that's going to be impacted by the loan servicing agreements and the 1099-G, which these payments are going to be reported on. We also want to talk about the implications that those are going to have, and then I want to spend a substantial amount of time on strategy and mitigation, because this is, for producers receiving these payments, this is going to be added income. It's going to just land in the, it's going to land on the books, and it will make the tax return bill go up, unless there's some mitigation things that are done over the course of the year. And then we're going to wrap up with some tax planning examples, just to kind of demonstrate some of the stuff that we're going to be talking about. Now, on these loan servicing assistance, already mentioned, this was a came out of the Inflation Reduction Act, which was passed last August out of the Congress. And part of this was, part of what the Inflation Reduction Act did was it opened up ad hoc payments for financially distressed individuals. And that was the emphasis on it. Now, this is not to be confused with prior legislation that was essentially targeting folks based on their ethnicity. That has nothing to do with what was happening out of Inflation Reduction Act. It's solely based on financial distress. Now, in order to get a payment, folks, they had to be, loan payments had to be in arrears. And I didn't want to get into the weeds about how far behind they had to be in order to get payments or anything like that. That's kind of a moot point at this point of the discussion. But they had to be behind in loan payments. And then what happened is that these payments were largely designed to get them current with their loan payments. So it didn't necessarily just pay off the entire loans, but what it did is it was designed to get them current. Now, this is not debt forgiveness. This is a critical issue, because debt forgiveness opens up all kinds of things with not only with FSA programs, but it also does some different things with the tax return. This is not debt forgiveness, right? It's just ad hoc payments, so it gets reported as income on the taxpayer's tax return. Now, the payments that the producer received, as long as it's over $600, it's going to be reported on a 1099-G. And it also is going to have to be reported on the tax preparers tax return, the taxpayer's Schedule F. Now, already mentioned this. The 1099-G is the form that it's going to get reported on, and your standard 1099-G that FSA uses got a little different look from the standard one that we get download from the IRS website. But nonetheless, it's going to show those payments. Now, there also, if the farmer had some interest that was paid over the course of this loan, they're also going to receive a 1098. Now, the 1098 shows interest that was paid on that particular loan, And of course, that interest is going to be able to be reported on the Schedule F as an expense. Now, the one thing that I will caution everyone on here is that, especially on the preparation side, the 1098 is going to distinguish between other interest and mortgage interest, and you don't want to overstate the mortgage interest on the tax return. So, you don't want to overstate that number. So you want to make sure that you match that up with the 1098 when you report other or mortgage interest on the Schedule F, because there's two different lines for that, and you don't want to over-report the mortgage interest. Now, this is what a standard 1099-G is going to look like. Now, the one coming from FSA, it's thinking more in terms of the 4-column variety, where it's the same form that for instance, an ARC County or a PLC or market loan gain would be reported on. I mean, this stuff all gets reported on the same form, and it'll just be listed as a loan servicing assistance payment. Okay, so what are the impacts of this, folks? These assistance payments may have been, if you got a producer that received one of these, they're either going to get it done by electronic transfer, and that largely, the way I understand it, was for the direct loans. All right, the direct loans were covered by electronic transfer. So in other words, the money went directly to the lender via electronic transfer, and the producer is going to get a letter indicating that transfer occurred. And if it's over $600, of course, there will be a 1099-G coming later on. Now, for everything else except the direct loans, it would have been paid by check. So in other words, the lender in this case, the farmer, would have received the check, but the check is going to be made out to both the farmer and the bank. So essentially, the farmer needs to endorse that check over to the bank, and then that would subsequently be used to reduce principal on that loan. Now, either way you slice it, the producer was going to get a letter indicating that these payments had been made, indicating the amount and everything, and then at the end of that calendar year, the 1099-G is going to show up. Now, something that the slide does not address here, and we want to make very, very clear. All right, these payments started in 2022. All right, they are going to continue. In other words, some producers received loan assistance service payments in 2022. Some are going to receive payments in 2023. Now, for somebody that received 2022 payments, right, today is, we're well into February and we're into filing season. The things that producers are able to do to help mitigate a 2022 tax bill sitting now without the ability to go back and do prepayments before the end of the year, you're going to be very limited in what you're going to be able to do at this stage of the juncture. Now, so the group that's going to have the most flexibility out of this would be the group that receives these loan servicing assistance payments in 2023, because those won't be reported on the 2023 tax return until about a year from now. So they'll be able to take advantage of a lot of the prepayments, the accelerated depreciation, and such. And for that matter, a 2022 individual, if they bought machinery, they're able to utilize 179 in bonus on those machinery purchases, and we'll touch more on that here in just a little bit. But the bottom line is, folks, these payments are going to increase the tax bill. They can't help but do that, because what it's doing is it's increasing income. So the mitigation efforts that I always want to point out to everybody is that you need to maintain, the producer that is affected by this needs to maintain a good working relationship with the lender, because in order to mitigate this, depending on the size of the payment, it may require the producer to have to borrow more money in order to do the things to help mitigate the tax bill. All right, this is creating, in some instances, it's creating a situation where additional money is going to have to be borrowed. Plus, you don't want to lose sight of the fact that if we increase the income on these pieces, we may be changing availability for health insurance. If you're enrolled in a plan on your state's insurance platform, it could push you into income where you're no longer eligible for that particular plan. So it's affecting a lot of potential things out there. Folks, what I am going to do on the questions, I see a few chats coming in here, and I haven't really opened those up. I'm going to focus on the presentation. What we'll do is we'll open this thing up for Q&A at the very end. Now, what I did is when we were preparing this presentation, I wanted to just illustrate what types of tax liability would get generated at various income levels. And what we have here, let me turn on my laser pointer here. Okay, so we have in this chart, we've got our taxable income, and that's the money that's actually reported on the return. I'm calculating federal tax, and this is one thing for tax planning purposes. We might as well get this out in the open right now. Okay, you've got for self-employed individuals, we've got two different kinds of tax that we have to pay attention to. We've got the regular income tax, which is what I label as federal income tax, and then we have the self-employment tax. All right, now self-employment tax is an extra tax that's on business income. Has to come from a trader business, but an operating farm is going to be a trader business, so it is going to be subject to self-employment tax. So we not only have to look at the federal tax, but also the self-employment tax. Those get combined for our federal tax liability. All right, which is what I've done here is I'm combining, this column plus this column is going to get you this column. Now, I did when I produced this, I put a Minnesota column in here because and this is going to be fairly similar to Wisconsin. When you look across the upper Midwest, Minnesota and Wisconsin have traditionally been states that have higher than average state tax liability. So I don't believe you'll find much difference between the calculated Minnesota liability and the Wisconsin liability. But the point that I'd like to make here is that you do have to account for the state tax liability, especially, Wisconsin is going to be very similar to Minnesota in that regard. And then we've got a total here, total federal and state. Now, we start to get to higher income levels, and we start to see that tax bill starts to swell quite a bit. Now, that's partially due to the fact that you're seeing we have a graduated tax rate scale. We have lower brackets, but once you get to higher income, that income that sits in those higher levels is going to be taxed at a higher rate, and that's just the way our tax system works on that. So, and bear in mind, these are 2022 numbers. Now for 2023, they're going to end up being very, very similar. Our tax brackets normally get adjusted for inflation, but we won't have those numbers until probably halfway through the year to know what the 2023 final brackets are going to be. Okay, a word on records, and I think this is a necessary discussion that we need to have as part of this overall arching discussion. Records, folks, I started out as a high school ag teacher in 1984 when I got my undergrad degree. And I taught high school ag for 6 years, and then I went to work for the Farm Bureau organization doing tax and analysis work starting in 1990. and remained there until 2004 when I came to the University of Minnesota, and I've been here ever since. So over that entire span of my career, when I've done workshops on how to keep a good set of farm books, that is the least favorite task that any farmer is going to undertake. Uh, they would rather, the farmer would rather be out in the shop, on the tractor, doing field work, working with the livestock. I mean, the last thing they want to do is be in the house messing around with a computer or a hand kept set of books. But it's really important because what we're talking about here is tax planning ultimately. And in order to tax plan, you've got to know where you're at. And the only way you can know where you're at is you've got to have a good set of books, going through the year. Now, most importantly, I think it's important that you have a system. Now, a computer-based system or a manual-based system, either one is going to work. I can't imagine for the life of me why anybody would do a manual set of books with a hand-done record book nowadays with computers. There's very cheap computer software that you just run a checkbook program and you can keep that up to date very, very easily. Now, the reconcile is very simply explained. I strongly recommend that if you're keeping your set of records on computers, on a computer, reconcile monthly back to your bank statement. All right, it's very simple. Just it's built into your software that you're using. Just reconcile back to the bank statement. All that's doing is that's assuring yourself that your farm records accounted for all cash that went through the checkbook. And if you've done that, that eliminates a lot of potential for errors. It really does. Your record system should include, a section for farm income and expense. You want a separate section for capital purchases and capital sales. And I like to put the personal income in there too, because if you don't keep track of it, you have no idea what it is. But the reason why you want to keep that separated is, sale of capital assets doesn't go on the Schedule F with the farm income and expense. All right, it gets different tax treatment. So that's why the record system needs to separate that stuff out. Okay, let's do a little tax refresher here. I want to run through some of this stuff fairly quickly, and I'm looking at the clock here, and I do need to ratchet that up, and that's my plan. The ordinary farm income and expense, I mean, that's going to be raised commodities, corn, beans, oats, any type of crop, raised livestock, custom services, like if you did a little bit of combining for the neighbor and the neighbor paid you, that's perfectly okay to put that down as as farm income on the Schedule F. That's all ordinary farm income. Now, capital assets. Now, if you took an accounting class, this is not the textbook version, but I think it's more of a layperson's definition. I consider a capital purchase anything that you need to consider depreciating when you purchase it. In other words, if you bought a tractor and you can't just, there are tools that we can use to accelerate the depreciation, but this tractor, you can't just put $100,000 tractor down as a repair expense on the Schedule F. It has to go on the depreciation schedule. All right. So it's certain assets, machinery, breeding livestock, buildings. Those are items that we're going to have to stick on the depreciation schedule. And when you sell those assets, all right, those are not going to get sold on Schedule F either. Those are going to get sold, and they're going to be subject to either depreciation recapture or possibly long-term capital gain. All right. Now, the sale of those capital assets, okay, it's going to either be going to be reported as depreciation recapture or capital gain. The form that it lands on is 4797, and ultimately that gain ends up flowing to the Schedule D on the tax return. Now, Wage and business income. All right. When you just talk about the regular tax rates are going to run anywhere from 10 to 37%. Now, just because you happen to have income, say if you had lots and lots of income and you happen to break into that 37% bracket, that doesn't mean you're paying 37% on everything. All right. You filled up a 10% bracket, and that money you're going to pay 10% on. Then there's a 12% bracket, and it graduates up from there. So it doesn't mean just because you're in the 37% bracket, it doesn't mean you're going to pay 37% on everything. All right, it's just 37% of whatever that income that happens to fall in that bracket. Now, self-employment tax. This is business. This is going to be on business income. And there's two components to that. Now the self-employment tax rate is going to be 15.3%. There's two parts to this. There's the old age, the OASDI, that's old age survivor disability insurance. That's 12.5% of that. 2.8% is Medicare. Now the OASDI portion for 2022 capped out at 147,000. In 2023, it caps out at 160,000. So that means that if you have income in excess of 160,000 in 2023, you quit paying the 12.5%, the 12.5 OASDI portion, but you pay the 2.8 into infinity if you've got enough business income out there to do that. All right, so that's how that works. Now, wage income, it's going to get reported on a W-2, and there's actually self-employment tax that gets reported on a W-2. That's your FICA and Medicare withholdings. All right, which employer pays half and employee pays half on that. Now, you also might see rental or investment income on the tax return. Now, that's considered passive income. It's not considered a trade or business. So typically, rental and investment income is not subject to self-employment tax. All right, but it's subject to the regular tax rates. All right, so again, that's just to illustrate how those two differ. Now, depreciation. Depreciation in layman's terms is when you have these capital assets, machinery, breeding livestock, buildings, drainage tile. When you install these things, you can't just write it all off on Schedule F in one lump sum. All right. Accelerated depreciation, yes, but it has to go through the depreciation process. Now, those assets are going to have to be put on the depreciation schedule. And what depreciation intends to do is it intends to spread out the cost of those assets over its useful life. So it's intended to spread out the cost of those items. Now, I do want to point out tangible property or repair regulations. Those came out 5-7 years ago, somewhere along those lines. And what that did is that gave a little bit of clarity as to what you actually had to depreciate and what you could just put down as a repair, and on those. So and what it did is there was a de minimis safe harbor on there where whereas you're able to, if an asset was small and it didn't cost that much, well, you can just stick that thing right on the Schedule F. You didn't have to worry about depreciating the thing out. Now, if you expense something under the repair regulations or the tangible property regulations, when you sell it, it is subject to the same recapture that you were going to have if you would have depreciated it all the same. Now, depreciation recapture. Here's what happens when you take something, you depreciate it out, and then you sell it later on. All right, you have to recapture that depreciation that you took on that asset. Now, the good part is that depreciation recapture is not subject to self-employment tax, but it's going to be taxed at whatever bracket that you happen to be in. That gets reported on 4797. So let's work an example here. Let's say, for instance, that I've got a tractor. We bought this tractor several years ago, and at the time we took Section 179 and we wrote the whole thing off in the first year, lock, stock, and barrel. All right. we are now selling that tractor for $20,000. All right. And the assumption is that we paid a lot more than $20,000 for it initially, but we're selling it for $20,000 right now. So we're going to have $20,000. This sale of $20,000 is going to be taxed as ordinary income, but we're not going to have to pay self-employment tax on it because it's depreciation recapture. Now that gets reported on 4797. Now, one other thing that I think worth noting on the tax returns, because this impacts a lot of folks. In 2017, we had the passage of the Tax Cuts and Jobs Act, or TCJA. In the Tax Cuts and Jobs Act, like-kind exchanges are still in place for if you're swapping real property. Real property would be land and buildings. All right, that's real property. Personal property includes machinery, and that's no longer okay to do under the like-kind exchange rules. So when you swap, if a farmer swaps tractors at the implement dealer, we no longer get a tax-free exchange on that. All right, so let's look at the old method on this. Okay, the old method on this, what we're doing is we're assuming that we traded in an old tractor, and we're going to get $20,000 allowance on that old tractor. The new tractor is worth $45,000. All right, so yeah, and I realize this is probably a utility tractor that we're talking about here. All right, under the old method, the implement dealer would give us an allowance for the traded in tractor. The implement dealer in this example gave us a $20,000 allowance. The new tractor cost $45,000, so all we had to do was pay the $25,000 difference, and we didn't have to recognize gain on the old tractor because we were doing a like-kind exchange. All right, post Tax Cuts and Jobs Act. All right, here's how this is going to get treated now. The old tractor, the traded tractor, is going to be considered an outright sale. All right, so that's going to be sold on 4797, and that's going to be $20,000 of income that's going to show up on the tax return, and we're going to pay $45,000 outright for the tractor that we're buying to replace it. All right, so we're recognizing income, and we're also showing more expense on the purchasing side of this. All right, so those are the differences. Capital gains. All right, capital gains, typically what you're going to have for capital gains is capital gains is typically going to be available for long-term capital assets. The most common thing is going to be farmland. As long as you've hung on to farmland for over 12 months, it's going to be subject to long-term capital gains when you sell it. Stock sales, it's a non-farm asset, but oftentimes if you've hung on to that for over 12 months, you potentially can get long-term capital gain out of those as well. So there's a variety of rates that you're going to find. Now we used to tie the capital gains rates to the tops of tax brackets, and that no longer is in place. That's another thing that changed with Tax Cuts and Jobs Act. All right, so there's actually a 0% capital gains rate out there. The way you figure this, the numbers on this chart, is you take all income on the return. All right, think of it this way: you stack, you put all the wage income in a pile, you take all the business income and you put it on a pile on top of it, and you stack it. All right, you put the capital gain on top of it at the very last. All right, then you look at where the capital gains fall into line compared to these thresholds for these various rates. All right, if we're doing married filing joint, this last one here, and we stack all the income, and I've got capital gains that is underneath the 83,350. After I stack it on top of everything else, that capital gain that's under 83,350 is going to be taxed at 0. All right, and then if it runs between 83 and 517, it's going to get taxed at 15%, and it's got to be over $500,000 in order for it to go to the 20% bracket. All right, so that's the way the capital gains now works. Okay, QBI. The QBI came out of the Tax Cuts and Jobs Act, and that's that 20% deduction that came out of the Tax Cuts and Jobs Act, because corporations, after the Tax Cuts and Jobs Act, got a flat tax rate. All right. Now, in order to appease everybody else, then this 20% QBI deduction was added in. Now, essentially, it's a 20% deduction, 20% of business. QBI is typically going to be business income, with some exceptions. But you take that 20% deduction, and then that's a deduction from the taxable income. It doesn't reduce self-employment tax. It doesn't reduce, it doesn't really reduce, it doesn't reduce self-employment tax at all. The reason why, there's two ways that farmers can get QBI. QBI can get passed through from a co-op. Okay, if you're selling with a co-op, okay, the co-op can pass through QBI, or used to be called DPAD, domestic production activities deduction. You can get that passed through on your 1099 PATR. Now, if with QBI, if taxable income is above these thresholds for married filing joint, married filing single, or single and head of household, okay, then you have to have basis in assets, and you have to have wages paid in order to get a QBI calculation. All right, and that's getting pretty much in the weeds. Here's a chart, and this is for 2022. The 2023 is going to look almost identical to this, except the breaks are going to be in a different spot once we get the finalized adjusted tax rates that we know for sure that where they're going to be for 2023. But let me explain what's going on here. The income tax regular tax rate is this blue line. All right, we've got a 10% bracket, and then we got a 12% bracket, and then we end up coming up here to a 22% bracket. And then the orange dotted line is that's your 15.3% self-employment tax. Runs out here to about 150,000. 147,000 is where it drops off. Then it drops down to that 2.8% that goes out here to infinity. The green line is just combining all three of those. Now, this doesn't take into account it doesn't take into account state income tax. But what this does is this just shows you the federal, where you're at from a federal marginal standpoint. So if income wise, you're out here in the middle of the green hump, or here in the middle of the green hump, I mean, you can see here, you're looking at about a 37% marginal tax rate on that particular money. It's not uncommon for somebody at fall tax planning to come in the door, and we sit down and we look at, all right, where are you at income wise, where are you at expense wise? Okay, we need to do some prepayments or machinery purchases with accelerated depreciation to get us down to maybe here. All right, because money that's up here is very, very, very expensive from a tax standpoint. I mean, a lot of times what folks do is they'll prepay down to the top of the lower bracket to get out of paying that expensive money on that. Okay, so let's talk tax planning strategies on here. Now, the tax planning strategies that we're going to discuss here, we're going to talk a little bit about prepayments, income averaging, deferral of income. We'll talk about accelerated depreciation, and also crop insurance. All right, so those are the leading items that I see coming into play with this. Now, prepaid expenses. This is no longer an option for folks that receive one of those 2022 assistance payments, because we're beyond 2022 calendar year. You need to be cash basis in order to do prepaid expense, and you can't, when you do a prepayment, the benefit of that can't exceed beyond 12 months. All right, if it exceeds beyond 12 months, you can't do that. Now, here's an example that you see here. For instance, you got a 1-year insurance payment that you paid in November. Okay, but it's a 1-year insurance payment. It doesn't go beyond, the benefit of that doesn't go beyond 12 months. So, if you pay that in November, you can deduct the whole thing in November, and you don't have to amortize that out. Now, remember one thing for year-end planning. You can, if you go to the bank, you can pay up all of your accrued interest up to December 31 if you're a calendar year filer, right? But you can't prepay interest, right? You cannot prepay interest. You can only pay up what's accrued at the bank. Now, the typical limit for prepayments is 50% of the total Schedule F expenses. All right, and the way that you arrive at that, that's including depreciation. You get to the end of the year when you're filing the return, you look at that total expense number at the bottom of the Schedule F, cut that number in half. That's the amount that you were eligible to prepay. All right, it's quite simple. You can go over that number if you're a farm-related taxpayer. Now, farm-related taxpayers are somebody that's, operating the farm operation, and they live on the farm, all right? Or it's also their relatives that live and work on the farm. As long as you haven't, if you're a farm-related taxpayer, and as long as you haven't gone over that 50% limit in the 3 prior years, you can go over for 1 year, all right? But you can't do it consecutive years, all right? So, that's kind of in golf terms, that's what I oftentimes refer to as the mulligan. Now, I think this is the most important slide on prepays. When you do a prepayment, folks, it has to be, you have to be buying something. All right, it has to be a payment, not a deposit. When I've had clients come in and sit down, and I'm looking at the co-op statement, and I see right on the co-op statement, money on account. In fact, it was listed as money on account. In fact, the farmer was getting interest payments for that money that they had on account. That's not a prepayment. That's not a prepayment. You need to have a receipt that says, all right, I bought this much fertilizer, this much chemical, this quantity of chemicals, seed, etc. I mean, you need to actually have, receipts showing these as actual purchases. You can't just put money on account at the co-op and call that a prepayment. The valid purpose is very simple. You're fixing price, and you're assuring yourself a supply, because oftentimes when you prepay in the fall, you get a discount. As with, with your seed purchases, there's all kinds of incentives to buy seed early. I've always had problems with this. The IRS says that we can't materially distort income, and frankly, folks, if we're doing this every year, we're really not. As long as we're abiding by that 50% rule, we're not really distorting income, because we're going to do these prepayments every single year. Okay, move on to the next thing, income averaging. Now, without income averaging, we could talk a whole hour on this if we wanted to. The income averaging is done on Schedule J. It's a schedule that goes with the tax return. It doesn't actually average income. What it does is it's blending the rates. It blends rates over the previous 3 years. Now, it doesn't affect self-employment tax. It doesn't affect taxable income, any of the aforementioned. But let's look at this chart here, and I think this will explain to you what's happening with income averaging. All right, if we look at our income levels, this line right here represents the top of the 12% bracket. All right, from a tax standpoint. Now, that number is going to change year to year. There's actually going to be bumps in that, but I've just flattened it out for educational purposes. Now, income in 19, for this particular example, we had some gap. We had some unused 12% bracket here. We had unused 12% bracket here and here. All right. Income went way up in 2022. All right. So what we can do is we can take money from here in the 22% bracket, and we can put that back. We have to put it back equally into the prior 3 years. And we can fill up those unused brackets in the prior 3 years. So in a lot of cases, what we're doing is we're swapping 22% money for 12% money. All right. And that's where the savings comes into play in this manner. But this is Schedule J, and IRS, by their own admission, says that this is an underutilized form. This is something for the 2022 folks that may have received payments that they didn't have a chance to do prepayments or anything. This is one of the few things that they can still do with that return to help mitigate that tax bill. Okay, deferral of crop and livestock sales, and this is this may not be applicable for everybody, but I want to trot through just some of the basics on this. There are ways to defer crop and livestock sales. The the key thing that we want to talk about here is the constructive receipt rules. If if you sold, if you go to the co-op and you sell commodity, you run the truck over the scale, and you're selling that commodity, and then you at the last minute you tell the elevator manager, no, I want you to hold the check. Okay, that isn't going to work, folks. That's constructive receipt. At that point in time, you need to take the money. There's deferred payment contracts, and that's what we're talking about here. Now, under the installment sale rules, you can do a deferred payment contract, which is you sign a contract with the buyer, and that contract says that you're giving up ownership of that commodity, but you're not going to get paid until after the first of the next year. All right, so if I sold commodity in December, say I took corn to the ethanol plant and I had a deferred payment contract, we signed that contract, and I'll end up getting my money in 2023. Right, you can't have any constructive receipt of income. The risk to these deferred sales contracts, and this is something I always want to tell everybody, you're an unsecured creditor when you do that. So if something happens financially to that ethanol plant or that co-op, and they experience some financial difficulties, you are the last person on the list that's going to get paid out of the bankruptcy court. All right, so just bear that in mind. Okay, weather-related sales of livestock. Sale of animals due to weather-related conditions. Now, this might be due to shortage of feed or water. It could be due to drought. We can do this with either raised animals, or we can do this with breeding stock animals. It can't be sport or poultry. Those are excluded from this. But what it allows us to do is it allows us to postpone gain on these particular items. Now, let's look at the breeding livestock. I'm not giving you all the code sections and everything for this, but there's a separate code section for the breeding stock that we see here. If I've got, let's say, for instance, I'm a cow-calf producer, and we experienced a horrible drought in 2022, and I ended up having to sell some of my breeding herd as a result of that drought because I didn't have enough hay, I didn't have pasture, I didn't have hay. I had to get rid of the breeding livestock. So if that occurred, if I sell more than my normal cull rate on breeding livestock, I'm allowed to defer those sales into into the future. Now, this is more or less a pseudo like-kind exchange. I have to replace those animals within 2 years. But as long as I replace those animals within 2 years, I don't have to recognize the gain on the initial sale of those animals. And that's a weather-related sale that we have on that. Now, if you have animals raised, such as, say again, I'm the cow-calf producer, and in this case, I'd be talking about the calves. All right, if I normally sold, if due to this drought, I had to sell more calves than what I would normally sell in any given year, I can defer that. Now, the one provision that is different with the raised animals is that you have to be in a disaster area. Okay, you either got to be your county either has to be a federally declared disaster area, or it's got to be an adjoining county that's a disaster area. And under those circumstances, you can defer that into the following year if you're selling more than that normal sell rate. If I sold more calves than what I normally would have sold in that particular year, and I had a disaster in that case. Okay, depreciation. look at this depreciation. We've got a couple of items here. Section 179. Now that's a fast write-off that we can do on class life between 3 and 15-year property. The maximum for 2022 was $1,080,000, and the qualifying purchase limit was 2.7 million. So there's a lot of money on the table with these things. Now, if your qualifying purchase limit goes over the 2.7 million, it's a dollar for dollar reduction of what you're eligible for 179 if you go above that 2%, that 2.7% limit. There are related party rules that I need to mention on this. If you cannot do this if you're buying for millennial descendant. All right, so in other words, if I sold a tractor to my son or daughter, in the farming operation, they wouldn't be able to take 179 on that tractor because they bought it from dad. All right, and that's what a lineal descendant is. It would also work for grandfather to grandkid because it's lineal descendant. Aunts and uncles are excluded from this because they're not lineal descendants. Okay, recovery period. Let's just kind of run down the list here. New machinery is 5-year property. Used machinery is 7-year property. Let's see here. Cotton bins, ginning assets, fences are still 7-year property, and those are going to be largely your main areas. Drainage tile is going to be 15. That always seems to come up in the discussion because there's a lot of tile that gets installed out there, and then tile is also eligible for 179. Bonus depreciation. Now, this is something that it's accelerated depreciation, but it's a little different twist to it. Okay, this works on the same classes of property as 179, except this includes 20-year property, which 20-year property is going to be farm buildings, also includes machine sheds. So you know, a farmer could put up a machine shed and take bonus on it. Now, 2022 was the last year that we had 100% bonus. In 2023, it drops to 80%. All right. So in other words, you can't write off 100% of the asset, but you can write off 80% of the asset in 2023. All right. The tax return, when you put an asset down, the tax return assumes that you are going to take bonus on it. You have to elect out of it by class life in order to not take it. So, you know, so what I would have to do is I'd have to say, I don't want to take it on my 10-year property, my 7-year property, and my 5-year property, but I might want to take it on my 3-year property. All right. So there's a way to do that. The related party rules are similar to 179, except you can do it if it's a related party if it's a related party transaction, as long as the asset is new, it's good to go with that. Okay, deferral of crop insurance. Let's look here on this real quickly. Cash basis farmers, you can defer crop insurance, but there's some yellow brick road things that you need to do. Okay, the only insurance that you can defer, folks, is it's only going to be the insurance that is due to damage and destruction of crops. All right. There have been for years these hybrid policies that also insure for revenue. Revenue coverage is not deferrable. All right. Let me say that again. Revenue coverage is not deferrable. You can only do the portion that's for damage and destruction. Okay, now here's what you got to have. You got to be cash basis filer in order to be able to defer. And under normal business practices, the income would have been reported the following year, and you just happen to get an insurance payment that particular year. Now, this is subject to a court case. This rule comes out of a court ruling that we have to go off of. So this is how the rules work. If, say, for instance, that you are a corn and soybean producer, all right, and you received insurance payments, crop insurance payments in 2022, and you want to defer to 2023, you need to look at your previous sales. If you normally would have sold over half of the corn in the following year, and you normally would have sold over half the beans in the following year, then you're eligible to defer that crop insurance into 2023. It's an all or none option. You can't just defer the insurance for the corn and leave the beans in place, or vice versa. It's an all or none option. I don't think that was the intent, Congress's intent, when they first passed this law, but these are the rules that we have to deal with right now. Okay, tax planning. Let's talk a little bit here about tax planning. And folks, I promise we'll get to the chat questions here. We're probably going to be about 10 after the hour before we wrap up. Here's the tax rates for 2022, and when we get to 2023, typically these amounts are going to be adjusted for inflation, so they're going to be similar to what you see here for 2023, but it won't change much from what we have here in 2022. The standard deduction is just an amount that we are able to take off of regular tax. It doesn't affect self-employment tax at all, but that's a deduction that we take off of the taxable income that allows us to put that down. Now, let's go to an example here and show you some actual numbers here. What I've got here is this is an example that I have, and I actually ran this through my tax software. Okay, we've got a farm with $196,000 of profit on Schedule F. All right. It's a married filing joint couple, so we had 25.9 was the standard deduction. That gets deducted from the 196. Also, since this is all self-employment tax, we get to take half of the self-employment tax, which would be the 11,739. We get that as a deduction off the taxable income, and also we've got our qualified business income, which is 20% of the 196. All right, so this gets subtracted. So we end up in this case, and we started with $196,000 worth of Schedule F income. We got taxable income down to 126 in this case. Now we're still paying self-employment tax on the full 196, but the taxable income is down to 126. So let me run the numbers here. I ran taxable income 126. We end up with a federal tax liability of 19,106. Self-employment tax is 29,477 for the total tax of 42,583. We're in the 22% tax rate. But our effective tax rate, that's the average tax rate without self-employment tax, is about 15.1%. All right, we can do better. All right, so we got 126,000 of taxable income. So if we look at our chart here, okay, we're at about 126. We're just about right here up in the middle of the big green hump with those numbers. All right. So there's if that was a situation where client came in November, we saw those kind of numbers, I'm going to send them out of the office with with some homework. Okay. What we decided to do with this is we're going to write off some new equipment that they purchased. We're going to fast depreciate that, either 179 or bonus. And we're also going to do some additional prepays of farm expense. All right. And what we changed here, and remember, this is where we started. Okay, we had the 196 Schedule F. If we go forward one, all right, I'm adding $50,000 of expense because I fast wrote off some machinery. I'm also adding $25,000 of prepayment to get that Schedule F down to 121. All right, now the rest of this flows into play. We still have a standard deduction the same, but you'll notice that our self-employment tax went down, as well as our QBI, but we still get that deduction off of the 121. So we're down to $69,000 on the taxable income side of things. So let's see what that did to us impact wise. We got taxable income of 69,241. Federal tax goes down to 78,96. Self-employment tax is a little over 17,000, or the total tax bills of 24,993. We're at a 12% marginal tax rate. Effective overall average without self-employment tax is 11.4. So if we look at this, we're at 69,000. So we went from here, 126, we went from here down to 69,000, where we went down to about here. All right. And essentially what we did is we cut the tax bill by $17,590 by adding essentially a $75,000 prepayment. Now, part of that was accelerated depreciation and part of that was prepayment. But the bottom line was we added $75,000 worth of additional expense to that. So we're saving close to 24 cents of tax for every dollar of prepayment that we ended up spending. All right, this is the typical prepayment scenario that we do when we do that fall tax planning issue. Now, I didn't run all the tax numbers here, but let me share with you just what's going on here. I've got a situation here where we've got $50,000 of Schedule F. But what we also have in this example is we had a machinery trade. And let's say, for instance, that the farmer had a $100,000 machinery allowance on a traded asset, say the traded combines. And they got an outright sale of the combine that was traded in, which gets added to income. All right. And what I'm doing is I'm running the numbers on this thing. We have our standard deduction, and then I'm taking my QBI and my self-employment tax on here. The good part about this piece right here is this $100,000, we don't pay self-employment tax on this, but it's still a big pile of money that's showing up on the tax return. Now, what has become a common occurrence with combating that is, as long as you don't create a net operating loss, you can take the Schedule F negative. So what happened in this particular example is we're doing some prepayment in the amount of $40,000, and we're also taking some accelerated depreciation off the new asset that we acquired. All right, and in turn what we're doing is we're making the Schedule F go negative to offset part of this gain that's showing up from the sale of the combine. All right, and what we're doing is by doing that, let me back up one. We were at $97,000, just about $98,000 worth of taxable income. After I do that, I'm down to about 35,000. All right, so you can take the Schedule F negative. It's just you can't have this taxable income number can't go negative. All right, you cannot make the Schedule F go negative with 179 with accelerated depreciation and have this thing go negative on you. Now, bonus, you can make this thing go negative, but if we're using 179, you can't. All right, you can't. So in other words, what we were doing is we took this thing. We were at 35,000, we were at 90 some thousand up here. Now we're down, we took this thing down to about 35,000 down to about here, which might have been overdoing it on there, but nevertheless, I think that helps illustrate some of the things that are happening. Okay, that wraps up what I had to do here. So let's pull up the Q&A, or let's pull up the chat here.
Yeah, Rob, I haven't put anything in chat yet. Any questions? Just questions about handouts, but this is an opportunity for those who are participating live. If you do have questions, feel free to put them in for Rob. He's obviously a wealth of knowledge and has some good info on taxes, as well as those loan servicing assistance questions. So we'll allow people to write that into chat or open up their mics at this time.
Because we'll hang out here for a while. And Katie, I did have one other slide that I wanted to show on there. So let me pop that thing back up here real quick if I could. One other thing that I'll point out here. Okay, again, those are the handouts, and that was in the chat. Here's something that you might want to jot down. Okay, if you want to do follow-up questions after the webinar is over with, if you email your questions to info@agftap.org, okay, that's a repository at the Center for Farm Financial Management on the on the University of Minnesota campus, St. Paul campus, and those eventually will go to me, and be happy to address those. But down the road, any questions from this, what we're doing is we're funneling those to the info@agftap.org.
Rob, I won't speak for the people in Wisconsin, but I know income averaging is not very popular in the state of Wisconsin. Do you have a reason or thoughts on why?
I think a lot of it, Katie, is that I think has nothing to do with producers. I think there's just been a lot of practitioners that in the past just, they only did it if they really saw a huge need for it. And I guess my experience is most cases, I'm going to go ahead and do that Schedule J every year. Just even if it doesn't save you any immediate tax, what it does is it makes more room to put money back into a future year when you get 2 or 3 years down the road.
Sure. Looks like we have a couple questions there, Rob. Other methods to decrease self-employment tax or self-employment income in regards to taxes.
Well, your large, now if self-employment tax is a big concern, then my number one recommendation is look into an S corporation. And the reason for that is that S corporations operate much like a partnership, but the shareholders are required to receive a salary out of the S corporation, but the salaries out of an S corporation, you're going to pay FICA and Medicare on that, because the earnings from an S corporation are not subject to self-employment tax. So the self-employment tax gets paid on that wage, FICA and Medicare. And now you have to pay a wage and everything, but that salary doesn't necessarily have to equal the amount of taxable income that the S corporation has. So one of the leading reasons for doing an S corporation is it's going to allow you to save some self-employment tax. So I'd encourage you to look into that and discuss that with your accountant. Let's see, going to make payments. Make payments on the amount of taxes. Okay, question. The last question here is about whether the IRS was going to augment the payments at all to if there was a increased tax liability. And unfortunately, the answer to that is no. The previous legislation that we had, where it was targeting ethnic producers based on ethnicity, those included an augmented payment, which was supposed to help mitigate the tax. This latest legislation with the Inflation Reduction Act, it was just addressing the payment of it just addressed the loan servicing payment, and that's it. So there was no augmented payment towards the tax, and that was set by legislative action.
Yeah, and that's a little bit of a misconception, because the discussion around student loan and potential payments for student loans potentially could be a tax-free, correct, Rob? And so that's a little bit different than what is that we're talking about today on this loan service.
Correct, because the student loan forgiveness is actually, that what's being talked about there is actual forgiveness. And what's coming from FSA on this, part of the reason, well, more than part of the reason, I think the main reason that FSA did not go with the forgiveness option is because once they forgive debt at the FSA level, then you're no longer eligible. You're automatically excluded from many of the FSA programs moving forward, and they didn't want to do that. So that was largely the reason why this was not a debt forgiveness situation. They decided to go with the augmented payments.
Right, because you're talking about not just Farm Service Agency payments, but also, you know, NRCS or other FSA, ARC, PLC, those type of payments as well, that forgiveness would not have been eligible for then.
Correct. It really caused it would really cause long-term problems for producers if they were to, receive debt forgiveness, because they'd no longer be eligible for loans. Many of the programs they'd be ineligible to participate in.
So you provide a lot of great detail about how potentially, especially those that have received payments in 2022, but also recognizing that we are under the impression that FSA will provide loan servicing assistance again in 2023. So trying to prepare some of those farmers as well for upcoming loan assistance.
Well, and Katie, in my conversations, I've talked with I guess our state director here in Minnesota with FSA, and they have said, there will be additional payments in 2023. They didn't get through everything in 2022. So the 2023s, the main message to the farmer population is that, make sure you watch that if this does occur, if you do happen to get these payments, have that conversation sooner rather than later with your tax professional, so you can get a mitigation plan in place.
Sounds good. And we'll be sure to send out a follow-up email with the handouts from Rob's presentation today, as well as that link to the AgFTAP portal that has more resources that Rob was referencing, along with links to Rural Tax, which is a great website with information from Rob, as well as other university extension services and specialists about just lots of different questions on tax issues. From my particular one I hand out a lot, Rob, is hobby farms and the difference between hobby farms and filing a Schedule F. But if you have questions, Rob provided that info, and we'll be sure to include that email address as well as his contact info. So I haven't seen any other questions come into the chat, Rob. So do you have any last closing thoughts?
Well, I just want to thank everyone for joining us today. I appreciate you taking time out of your busy schedules, and don't hesitate to reach out to us on that that AgFTAP email address.
Great. And I just put in the survey link for today's webinar. Again, our information and Rob's time today was provided in part by some federal funding. And so we are, both of our universities are recipients of federal funding. So we would ask you to complete the survey. It will also show up as we close out our webinar today. So with that and no other questions, Rob, I thank you for your time today.